So the value of your currency is starting to drop. What do? How do you protect your investments? Well, a lot of people are turning to what looks like a really simple tool, currency ETFs. But are they the straightforward hedge they seem to be, or is there a hidden risk lurking just beneath the surface? Okay, let's dive right in.
First, let's just set the stage here. In 2025, the US dollar has dropped about 9% against a whole basket of major global currencies. And look, that's a big move. It has very real consequences for your money. To put it simply, a weaker dollar means that everything, from that vacation you were planning in Europe to the imported goods you buy, it all gets more expensive. Your money just doesn't go as far on the world stage. So what's really going on here? To really get a handle on this dilemma, we have to look at the numbers. I mean, what does this weakness actually look like? Okay, so this is the US dollar index. It basically measures the dollar's strength against currencies like the euro and the Swiss franc. And as you can see, it's taken a pretty sharp dive, the fastest drop we've seen in years. Now, this isn't some kind of currency collapse, but it's definitely a trend that has investors scrambling to protect their portfolios. And that brings us to the solution that's been gaining a ton of traction: foreign currency exchange traded funds. You know them as ETFs. You have products like the Swiss franc trust and the euro trust. They're designed to give you direct exposure to a foreign currency. The idea is super simple, right? If the dollar falls, these other currencies should rise, and that offsets your losses. And this is exactly why they're so appealing. I mean, look at this. While the dollar was tanking, these two ETFs posted gains of over 13%. On the surface, that looks like a perfect textbook hedge. Seems like a simple and super effective way to protect your portfolio, doesn't it? Well, this is where our story gets a whole lot more interesting. To really understand the potential risks, we have to pop the hood and look inside the machine. So, when you click trade on one of these ETFs, what are you actually buying? The answer might surprise you, because it turns out not all ETFs are built the same way. Yeah, what is really inside that thing? Well, the answer comes down to two very, very different ways of putting them together. Okay, so here are the two fundamental ways these ETFs get made. On the left, you've got physical replication. This is probably what you're imagining. The fund literally buys and holds the actual currency. Simple. But on the right, this is where things get weird. It's called synthetic replication. With this, the fund doesn't own any currency at all. It uses a financial contract to just mimic the performance. So how do they do that? Often with something called a total return swap. Think of it like this. The ETF provider gives a big bank a pile of cash. In return, that bank promises to pay the ETF whatever the euro goes up or down. The ETF gets the performance of the euro without any of the hassle of buying or storing it. But as you can probably guess, this introduces a whole new kind of risk into the equation. And this quote from the Bank for International Settlements just nails it. With a physical ETF, your biggest worry is something called tracking error. Just a small risk that the fund's price doesn't perfectly match the currencies. But with a synthetic ETF, you've swapped that pretty manageable problem for a much, much bigger one: counterparty risk. Suddenly, you're not just betting on the euro, you're also betting that the giant bank on the other side of that deal doesn't go bust. Okay, hang on. All of this talk about risk might have you thinking about other currency products you've heard of. So it's really important that we pause for a second and clear up a super common point of confusion. The ETFs we've been talking about are completely different from currency hedged ETFs. So here's the deal. A currency ETF, like the ones we've discussed, is a direct bet on the euro itself. A currency hedged ETF is actually the opposite. It's for when you want to invest in European stocks, but you want to completely strip out the effect of the euro's ups and downs. You're betting on the companies, not the currency. So you might choose a currency hedged fund if you want to invest in, say, Japanese stocks, but you think the yen is going to get weaker against the dollar, which would really hurt your returns. You're trying to isolate the performance of the stocks themselves. See? It's a totally different game. Okay, let's get back to the main event, those hidden risks inside the direct currency ETFs, especially those synthetic ones. It's time to read the fine print. The Bank for International Settlements points to three major worries. We've already talked about counterparty risk, what happens if the bank on the other side of the deal fails. But then there's collateral risk. The assets the bank sets aside to back your ETF, well, they might not be cash or bonds. It could just be a random pile of illiquid stocks from their inventory, completely unrelated to the currency you think you're tracking. And finally, there's liquidity risk. In a major crisis, nobody's really sure if these complicated setups could handle a mass exodus of investors all trying to get their money back at once.
And if all those risks weren't enough to think about, there's another little surprise waiting for many investors when tax season rolls around.
You see, a lot of these currency and futures ETFs fall under a special tax rule called Section 1256. And for short-term traders, this is actually pretty sweet. No matter how long you hold the ETF, even if it's for a single day, 60% of your gain gets taxed at the lower long-term capital gains rate. But, and this is a big but, it gets even more complicated. If you invest in an ETF that physically holds a commodity like gold or silver, your long-term gains can get taxed at a higher collectibles rate of up to 28%. The big takeaway here is that the way your ETF is built has very real consequences for what you actually get to keep after taxes. And this is where it all comes together. Now listen to this quote from the BIS. They're not talking about today's ETFs here. They're talking about the complex junk that was at the heart of the 2008 financial crisis. But the parallel is kind of chilling, isn't it? A lack of transparency and complex inner workings make it hard for anyone to truly understand the risk they're taking on.
And that is the core warning from one of the world's most important financial regulators. When a product goes from being a simple box of stocks to a tangled web of swaps and collateral, the potential for nasty surprises just grows and grows. So the next time you look to an ETF as a simple solution, it's worth asking yourself this question. Are you just buying a stock that tracks an index? Or are you actually buying a complex slice of the global financial system with all the hidden risks that come along for the ride? Knowing the difference is absolutely crucial.